This is the Money Show with NJG. Tonight we're discussing index funds. Want to earn an 8% return? It's possible with index funds. You invest in the stock market and you get the stock market return when you invest in an index fund. If you earn 8% over a 45-year period, you'll have $1.4 million. You'll have over $950,000 if you do the same thing over a 40-year period. If you invest only over 20 years, however, with $300 a month, you'll have just $170,000. And if you invest that over a 15-year period, you'll have a mere $101,000. So if you start early, even with a 6% inflation rate on $300 a month at 8%, still have $104,000. You'll be in the exact same position as the guy who invested for 15 years with 0% inflation. See how much that gives you extra room? The stock market returns are not guaranteed, and over the last 10 years, we're in the 3 to 4% range, largely because of dividends. The capital growth rate was very anemic. It was far less than 1% for the capital growth rate from the market peak in 2000. So it went from 11,800 in the Dow Jones Industrial Average to 12,100 yesterday. The S&P 500 index is a more accurate indicator than the Dow Jones Industrial Average because it's made up of the 500 largest companies in America. While the Dow Jones Industrial Average is diversified if it's a random sample of stocks, the S&P 500 index compiles the 500 largest stocks in America. The Wilshire 5000 index is even more diversified because it gives you large cap, small cap, mid cap, whereas the EFA index does international stocks. The Russell 2000 does small cap stocks. Why invest in stocks in general? Stocks allow you to outperform inflation. If you have inflation and you have your money in the cash or bond markets, you might, just from the cash sitting there, underperform to inflation, but you will definitely underperform to inflation, with the rarest exceptions, i.e. 1980 to 2010. You will underperform when you take into consideration what you're going to have to withdraw in retirement. And that's the reason why it's important to have some stocks in your portfolio. As I had mentioned earlier, 6% inflation with your $300 a month puts you in the exact same boat as a person who starts retirement saving 15 years from retirement. That means you would have to sock away about $2,975 a month to be a millionaire in today's dollars. Whereas the person who retires 15 years from now will be a millionaire 15 years from now. So that will hamper his retirement ever so more. What if you can't earn 8%? Well, if you earn 7%, you'll have just a little over $1 million, $1,060,000 if you have 45 years, or $740,000 if you have 40 years. An index fund is a good investment for 3 reasons. 1, it has low cost. Index funds have lower cost than typical mutual funds. 2, mutual funds poorly time the market. In a mutual fund, you can beat the market, but it's not likely. If you take up all the funds in the market universe and you average them, they cannot do better than the market. It's just impossible. Then you have higher fees on top of it. You have trading costs. Every time the fund trades, cost of money. that hurts your return. Lastly, you have taxes. Taxes are more when you trade constantly. If you trade the portfolio once every year, you'll have a bill on the entire portfolio. It'll be all short-term capital gains. If you rarely trade the portfolio, as you do in an index fund, the only taxes you're going to have is dividends and the transactions that were made. That's a nice tax bill. Consult your tax advisor. When making investment decisions, choose an asset allocation that's appropriate for you. That's why that 8% return is even more unlikely for someone nearing retirement, because they can't take on as much risk. For instance, if you have 15 years to retirement, you're probably only in 60 to 70% stocks at most, because you can't afford to lose the money. If you had it from 1995 to the present, you had hardly a return at all, especially if you sold in 2009 when you panicked. You basically broke even. That's no good. So when you make a decision to invest, you have to pick an asset allocation that'll make you feel comfortable, so that when the 2009 market does hit and you lose 60% of your money, you're not panicking. You are relaxed and you say, okay, I can get more aggressive now because I was sensible with my money and I didn't blow it. So an index fund gives you the average return. What happens when there's a market downturn? What happens to the typical active mutual fund? Well, the average mutual fund works like this. When the market's soaring, people want in because they want to participate. When the market plummets, people want out because they want to preserve what's left over. So guess what? These emotional beasts, mutual funds, managers that are professionals, have absolutely zero crystal ball. They tend to do exactly the opposite of what's good for returns. And that's the reason why most mutual funds underperform the market. It's essential to make sure to work with a trained advisor, do your homework, so that you pick a good asset allocation so you don't panic and you have a prudent strategy over time. This is Nathan, signing out.